Howdy folks, we have a lot to discuss in today's video. We have so much to talk about. Obviously, we're going to talk about Tesla right off the top. It just blew through another multi-year low. It's just day after day after day. We got to obviously talk about Tesla. We're going to talk about many other stocks in this video. I want to talk about some very important things that are going on in the market. I have to show you. Obviously, we're just going to spend a moment talking about Jay Powell and kind of the Fed and kind of what happened there and the ramifications that means for the market as well. So many various subjects to discuss today, guys. Busy video. I appreciate everybody joining me as always, and thank you for being subscribed to the channel. So Tesla just fell under a $500 billion market cap for the first time in years, down another 2.5% here today. The stock remains in complete free fall. This stock on red days goes red, on green days goes red. The stock market could be even, it goes red. It does not matter for Tesla at this point in time. And this stock is just going down day after day after day. And it just seems like relentless selling pressure with lack of buying pressure on the other side. And it just seems like it can't get out of its own way. Like it doesn't matter. The stock just goes down, right? And now we're up to a 60.7% year-to-date loss now on this stock. It is incredible. The decline here in Tesla, which is a company that's had amazing numbers this year. There's many other stocks in the market that are down 60, 70, 80%. But the difference between Tesla and those other companies is Tesla's put up these amazing quarters, quarter after quarter after quarter after quarter. And yet they get a 60% plus decline in the stock price this year, right? So it's a very different scenario than a lot of these other companies that have had horrible numbers, massive misses, and people are looking at them and you understand why the stock goes down 60, 70%, right? Tesla has not been that sort of year for this company, but it did go into the year with a massive backlog. It's in the year without a massive backlog, and it did go into the year in a big valuation territory, and it's exiting the year, and there's a massive change that's going on right now that I have to show you in regards to this, okay? What did I tell you guys yesterday? I told you that just wait, Wall Street, they're going to have a lot of price target cuts coming, and also a lot of these, where we might move it from a strong buy to a buy or from a buy to a hold, and all these analyst predictions and things like that. And sure enough, here today, things just start. And this is just the start of it, okay? There's going to be a whole lot more coming for Tesla here, okay? Goldman Sachs today has cut its price target on Tesla to $235 from $305. That's a massive cut, but it is maintaining its buy rating for now on the stock as it still sees positive long-term prospects, says Goldman Sachs, right? So many of these situations are coming, it's not even funny, where people are going to drop price targets massively, or they're going to go in and take things from a buy to a hold or from a hold to a sell and those sorts of things, okay? Now, they did say some very important things that we have to read through here, okay? We believe that Tesla remains well-positioned for long-term growth as EV cost structure and full solution leader, providing vehicles, charging, storage, software services in a well-integrated manner. And we maintain our buy rating on the stock, says Goldman Sachs analyst Mark Delaney. However, Delaney said the firm is now switching to a PE-based price target. That's a major change. If you're talking about the way you're going to change the valuation of the stock, right, and how you're going to value it, and now these folks are going to go to a PE-based price target, that's obviously going to be a whole different situation in terms of value in the stock, right? And has introduced a new model for its 2025 EPS estimate. Okay, that's a major change. From a deliveries perspective, Goldman sees Tesla hitting 420,000 deliveries for Q4. That's down from 440,000 prior. And 1.85 million units in 2023, down from 1.9 million. So not big differences there. The major epic difference is right here, switching to a PE-based price target, okay? And that can change things dramatically in terms of the way you're valuing the stock if all of a sudden you're changing to that, right? Delaney notes that while the company could have production capacity for around 2.4 million units in 2023, macro indicators in several regions Tesla operates are moderating. And Tesla's recent moves such as price cuts and issuance incentives insurance incentives, suggest that the global demand is now softer for Tesla. Absolutely. However, Tesla has a number of positive cost drivers coming up in the years ahead. This is why I highlighted this, Delaney said, citing ramps in Austin and Berlin that could boost profitability, new battery cells, IRA credits, and potential new vehicle platform that could cut costs around 50%. Okay. So What you're reading through there, that is massive. And that's why I highlighted that there, because obviously Tesla's in a position where, I don't think we've seen necessarily peak margins for Tesla long term. Is it possible Tesla's margins could go down in 23? It's a possibility. But I don't think on a long-term basis we've seen peak margins. I think Tesla actually has quite a bit to go in terms of the whole margin story. It's a possibility that margins maybe come down for one reason or another in 2023, and that will give the false interpretation that Tesla's margins are now starting to fall. But actually, I think long-term, Tesla's actually got quite a ways to go. They're still very early days in the whole profitability game and in the margin game, okay? We believe that passing reduced costs on to consumers, as well as factors like expanding leasing programs and consumer tax credits, could help Tesla to drive growth in margins. However, the degree to which these levers will help volume and the cost to Tesla to achieve them will be key to monitor Delaney Writes, okay? So obviously he's changing a lot in terms of his perspective, but specifically around valuation, okay? Now, here's what I'm thinking of for Tesla, okay? I'm going very conservative into 2023. Obviously, I'm ultra bullish on Tesla long term. This is a company I believe is going to end up, by the end of this decade, selling 10 million plus cars a year, okay? So I would definitely put myself in the ultra bullish long-term camp that I've been in this camp since, probably, 2018 or whatever, right? But here's the deal. I'm very bearish on 2023 for the company because I am very concerned about the global economy in 2023 and the global economy getting worse as the year progresses in 2023. And so analysts have EPS at around 550. I have them maybe at like 450. If they do 550 plus, I will be a happy camper as a Tesla shareholder. I just don't see that happening. The reason is one, I don't have them growing nearly as much revenue in 2023. I do have them growing in 2023, but not the rate that analysts have them growing, about 40% roughly. I think I'd be happy with about 20%, to be quite honest, okay? And also I think, with obviously them starting to get Cybertruck up and running, there's going to be some real, let's call it downward price action in regards to the net income of the company, because we know every time Tesla ramps a brand new vehicle like that, the first quarter or two, they lose a ton of money, right? And it causes some short-term kind of financial hardship for the company. So I'm expecting that. So I think, honestly, 450 is my realistic number, right? I would not call that necessarily my most bearish case. I have actually a much more bearish case than that. And I certainly not my most bullish case in regards to 2023, right? But that's what I think they're going to do, which would put this stock currently at a forward P of somewhere around 34, roughly, okay? Now, in this market, given how many other extraordinary deals there are in this market and so many other stocks, I want Tesla at basically a forward P under 30. So to get down to a forward P under 30 based upon my number, right, I need the stock to go to 133. So that's what I'm looking at as a buy. So if, let's say Tesla tomorrow, for whatever reason, and it's not going to trade there tomorrow, but let's say Tesla was trading at 133 tomorrow, I would be a buyer of this stock. And I'd put out a video that says I am buying Tesla stock again for the first time in years, okay? So that's my number I personally have in mind is 133. We hit there, we go under, that's where I start accumulating. And like I said before, many times with Tesla here recently, it's not impossible for the stock to go under $100. And I think we just all have to get mentally prepared for that. And if we get a major recession, this baby will go under 100 if we get a major recession. That's a big if, right? Now, I saw something on a message board that kind of frustrated me. I don't know if it frustrated me. I just thought it was worth addressing, okay? Because somebody was kind of pointing out that, Tesla's having such a bad year. And I think there was somebody that got a little frustrated with that. And they're like, look at all the other EV names. They're all down huge, right? Look at NIO, look at Lucid, look at all these others, right? And my opinion is, don't compare Tesla to NIO or Lucid or any other companies, right? Lucid, who knows, they look like they're on their way to the gulag, which is the under $5 club, okay? And Lucid could go bankrupt. Unless they raise massive amounts of money over the next few years, they could very much go bankrupt, okay? NIO, I don't think you should compare NIO to Tesla. I don't think you should compare any of these companies to Tesla. It's just, Tesla's at such a different level than these companies. It's almost silly, in my personal opinion, okay? It's like comparing McDonald's to a small burger chain, like comparing McDonald's to, I don't know, Shake Shack or something like that. It doesn't make sense, okay? The ones you should be comparing Tesla against, if you want to compare them against other companies, compare them against other big dog tech companies, compare them against an Apple, compare them against a Google, compare them against an Amazon. I think Amazon, in my personal opinion, Amazon is the most direct company that if you want to compare Tesla to a company, compare them to Amazon. Amazon's a company that has a great long-term story, a great track record over time, a higher valuation name, no doubt, right? And always commands a higher valuation name because it's always seen as a company that has so much room for not just revenue expansion, but margin expansion and profitability expansion over the next 5, 10, 15, 20 years, right? Which fits into the same category as Tesla. So in my opinion, if you want to compare Tesla and you want to look at stock prices and gains and losses and all those sorts of things, compare them against a company like an Amazon, or compare them even against a company like Apple. Apple's obviously way low growth compared to something like a Tesla, but if you think about kind of Tesla's business model, it's kind of similar to an Apple in respect of like they sell their hardware product, but then they have all these kind of like software, like let's call it back end ways they can make money, which obviously there's things like the autopilot program, things like I Pay For, which is a connectivity that I think is like $10 a month. So you have satellite maps and a bunch of other features on your Tesla, right? And that's very similar to obviously Apple and their app store and all the different kind of ways they can make money on the back end in regards to that, right? So those are the companies you should be comparing Tesla against. Don't be comparing them against Lucid and Neo and companies like that. It's just, in my opinion, an absolute joke. It's ridiculous. There are so much different levels you can't even compare them, okay? Now, talk about the Fed here, and then I got some important stocks and things to show you in regards to the market that's going on that I think is important, okay? So in terms of what happened today, right, the Fed raised rates 50 basis points, which doesn't come as a surprise because the CPI number came in a little light, which was good news. But at the same time, let's keep in mind, the Fed, and I watched most of that Powell conference, I would say maybe 70% of the Powell conference. And what it sounded like to me is they are staying committed with, basically keeping rates high for all of 2023. And until 2024, at some point, they might cut. Now, my opinion is it all depends on really how long the economy can stay strong for. Sure, if the economy stays strong for all of 2023, which I don't think is a realistic possibility, but let's imagine that, then sure, they'll keep rates high for the whole year because they'll have no reason to cut rates. No reason. But here's the deal. If the economy starts to fall off the rails while inflation is getting closer and closer to their 2% target, let's call it, right, that would be a moment that they would cut. And but that would be obviously the reason they would cut is because the economy is in a very bad place and earnings are tanking, which obviously isn't good for the stock market and obviously isn't bullish for the stock market, right, at least in the short term. So that's a problem for us bulls is we're kind of in a no-win situation right now where if the economy stays okay, the Fed's still going to keep these rates insanely high until something breaks, right? And then if something breaks, that means we're probably going down big time in the market. So as long as we're kind of in a no-win situation in the short term, but it is what it is. It's just what we have to deal with nonetheless, okay? And so the Fed's remaining committed to keeping interest rates at very elevated levels for all of 2023. But like I said, it's all dependent upon how long the economy can hold on for. And if you look at the indexes today, there weren't any massive moves. All the indexes finished red, but it wasn't like Red Dead Redemption type day, right? And I think that's because, Powell didn't have anything and the Fed didn't have anything that was shocking today. They did the 50 basis points. Most folks, like 80% of folks on Wall Street expected 50 basis points. And in terms of the commentary, it was kind of what you expected. It wasn't hawkish. It wasn't dovish. It was kind of what you expected. And in terms of Powell just kind of walking that fine line about we're going to keep rates elevated, for 23 and until inflation comes down to our target and those sorts of things. And we're going to see, potentially some job losses, but it's not going to be major job losses. And we'll see if that's a far-fetched fairy tale. Time just has to play out there. Okay. Now, in regards to stocks I own, interesting kind of pricing action because the ones that you would expect to be the weakest stocks are still the weakest stocks, right? Stocks like Fubo, stocks like Palantir, stocks like the Chef, right? Tesla, Oatly, those sorts of companies, my worst performers here today. Well, best performers are, look at Elf. Elf hits pretty much an all-time high. Pretty much, it seems like almost day after day after day, Elf hits a new all-time high. Target was strong today. Meta continues its comeback. Remember, Meta was a stock that was in the 80s just a couple months ago. That stock's been climbing out like it's nobody's business. I mean, geez, it's been impressive performance. Let's just call it that, right? Avon made a little brand there. Pfizer's been a great performer for me in my dividends only account, right? Honest continues to have its comeback, eventually get out of that gulag and go on to prosper. But, obviously they got to put up the numbers, right? And Revolve's just a great company with a very good balance. No, not a very good balance sheet, a great balance sheet at that company. And they're one of those companies that even in a recessionary environment, environment, I expect them to be cash flow positive and net income positive on a yearly basis, even if we have a recession, because they're that well run of a company and they just put up those sorts of numbers. So yeah, it's kind of almost what you expect on a day like today, right? By the way, in terms of honest, I just did a massive 50-minute beast video reacting to their latest Morgan Stanley conference. So if you want access to that, it's absolutely free. I can send it over via email or I can text it over to you. And yeah, that's pretty awesome. So definitely, check out that if you're interested in that. It's absolutely free. Okay, that will be pinned comment down there if you want that. If we look at big tech here today, look at the worst one, AMD, right? And if you think about all the worst stocks in big tech world today, these are all companies that have major issues in 2023 working for them, right? And, AMD is going to have a year cut out for them. I'm going to be a buyer of AMD stock in 23. I would say 99% probability I'm buying AMD stock and building a nice position in AMD in 2023. It's going to be a tough year for AMD, a very tough year. It's going to be a battle for them to even hope to show growth, in my opinion, for AMD in 2023, right? Tesla's going to have a tough year with their numbers, in my opinion, right? And I think they can still grow in 2023, but in terms of that 40% growth rate, I have a lot of questions about that, right? Intuit could have a tough year, actually. Intuit's one of the best business models around. It's literally amazing. But if small businesses start to get hit in a major way, don't be surprised if Intuit numbers show that weakness, at least in the short term, right? NVIDIA is going to have a tough year for them, cut out, obviously everything semiconductor. Intel falls in that category. And I think Apple's going to have a tough year as well. I'm expecting revenue to go negative for Apple for the first time in a long time. And I'm expecting net income for Apple to go negative. Not negative in terms of they start losing money, but negative in terms of they aren't making as much as they made in this past fiscal year, which they're already in their new fiscal year. And most analysts aren't in that even of that camp yet. The analysts still had this company growing revenues and growing EPS in fiscal year 2023, which now we're in. And I just don't see that happening for Apple. I think it's going to be opposite. And I think we'll see that play out in the numbers. And so does Apple go to under 100? If we get a major market sell-off, absolutely. If, the market stays around where we're at, no, it could go down 120 or so in that scenario, right? Cathie Wood, I know we don't talk a lot about Cathie Wood or the ARK Fund or anything like that. A lot of people aren't as interested nowadays, right? But I think at some point, the ARK Fund will come back in 2023. I just don't know what quarter it will be in terms of that baby starting to kind of come back. Nonetheless, I just feel like you're better off picking your own 10, 15, 20 stocks and building out your own portfolio and doing the research in those, in my personal opinion. That's been my opinion for a while in regards to this, and it remains my opinion in regards to that, okay? Affirm. This is a stock we never talk about, okay? It's about a $3 billion market cap. The stock is down almost 90% year to date. It looks like it's on its way to the gulag, right? The under $5 club. It looks like it's on its way there. I mean, you just look at this stock, it's been in complete free fall this entire year. And it just gets worse and worse and worse in regards to Affirm. And it's amazing because this company went public literally at peak FOMO in the market. January of 2021. That was the peak for the market in terms of the excitement phase, the FOMO phase, everything's going to the moon phase, right? And it shows that they went IPO and the stock went up 90% almost instantly, right? And it's crazy because it seems like it's one of those stocks that is the most fitting for that era. We were in there at the very end of 2020 and the beginning of 2021, which was just a crazy time period that was the craziest we've seen since, honestly, the tech bubble days, right? And now it can't be anything but that, right? And in terms of Affirm, there's definitely risk to Affirm in a major, major way, right? Because imagine the economy starts to weaken, imagine people start to default on these Affirm payments and things like that. There could definitely be something that hurts Affirm in a major way, right? And if you look at Affirm's numbers, this is from their latest quarterly report that they came out with back in November, so last month, right? What we saw is it looked like everything's growing great, right? Gross merchandising volume up substantially, active customers up substantially, transactions per active customer up substantially, revenue up substantially. And so that looks great. And so if you were just looking at a slide like this, you're like, oh my gosh, Affirm's great. This is amazing, okay? But when you dig a little deeper, you find definitely some kind of fatal flaws here, okay? And here it is. Look at this. This is their GAAP operating income loss, their loss, okay? Just in this latest quarter, right? They had a GAAP operating loss of almost $300 million. Now, even if we take their adjusted numbers, right? Which adjusted numbers are essentially, let's include what we want to include and not include, right? They're still negative. And here's the problem. This is with record low unemployment. Like, imagine a scenario where I don't even want to say 10% unemployment, but just imagine we go to 6% unemployment or 5% unemployment. If anything, I'm going to guess there's going to be a lot more defaults in terms of a firm, right? And that puts a whole new risk into the business model that we haven't even really begun to see yet, but we could definitely start to see that emerge in 2023. And I think this is the reason why that stock is down so much and why it looks like it's on its way to the gulag, is because people are realizing, oh my gosh, like there could be epic risks to this company if people stop paying these affirm payments, essentially, right? Which is certainly a realistic possibility. And so I put Affirm into the same category that I put other speculative stocks, right? Like Fubo or the Chef or Oatly or some of these stocks, because at the end of the day, those companies almost all go together. And there's a lot more that fit in that category, right? Where it's like, if they can just get through the next 12 to 18 months, there's excitement there, right? And Affirm's huge growth. You look at a stock like Fubo, huge growth, but massive money loser. And it doesn't look like it's going to fix itself anytime soon. And so those are the sorts of companies that it's like, if they can get through the next 12 to 18 months, yeah, there's a big potential upside there. But can they get through that next 12 to 18 months, right? And I think that's a real concern with a stock like Affirm, and that's why it gets, in my opinion, grouped into a lot of those other stocks. And I wouldn't be surprised if we see the economy start to fall apart in 2023 and just get worse as the year goes on, and we see unemployment tick up. I think a stock like Affirm could go to the gulag, which would be pretty darn shocking for a company that was, a darling of Wall Street less than 2 years ago, just 22 months ago or so, 23 months ago. It's insane to go from that darling of excitement to potentially going all the way down the gulag area. Incredible, right? Now, this scares the crap out of me, okay? The Dow's hardly down. I don't know if you guys have noticed, the Dow is hardly down. Yeah, the NASDAQ's gotten hit. Yeah, growth stocks have gotten hit. Stocks like Affirm have gotten hit, and the Cathie Wood stocks, and anything that's a money loser, those stocks have gotten hit, no doubt. NASDAQ's gotten hit in general. But at the end of the day, right, the Dow's hardly down. This is a 5-year chart of the Dow. This scares the living crap out of me, to be honest, okay? In a major, major way, because all I look at is, did you guys see what happened in 2008? The Dow gave an illusion. This goes all the way back to the end of April, beginning of May of 2008. The Dow was given an illusion that everything was fine, very similar to right now, where the rest of the market's kind of started to get hit, but the Dow's giving this illusion of like, everything's fine. Everything's fine. And you got to think, like, could the next 9 to 12 months we have a massive sinking of the S&P 500 and the Dow? And that's something that concerns me. I'll probably do a full-scale video about that if I got the energy later tonight, because I think that's a whole subject in itself that I need to potentially dive into, and it's an important one. For now, I need to go cash in my Caleb Williams bet, okay? I bet him to win the Heisman before the season. The man did it. He's the only bet that might have come through for me this year. I appreciate that, okay? Hope you guys enjoyed today's video. As always, once again, if you want that honest 50-minute beast video, check out the pinned comment down there, and I'll either email it over to you or I'll text it over to you. Much love as always, and have a great day.